Hi everyone, welcome back to Providend Money Wisdom Podcast. I'm your host Isaac, Associate Advisor at Providend. Join with me today is Bryan Chan, Client Advisor at Providend. Hi Bryan.
Hi Isaac, very nice to be here.
Yeah, so for some of you may know that Bryan has actually been working from anywhere. So we have this work from anywhere program at Providend, and Bryan has been working from Turkey for the past 6 months. Is that correct?
Yes, around about 6 months.
Yeah. So what you miss most about Singapore when you were working from Turkey?
Two things. The first is definitely family and being around people. So being in Turkey initially, like not knowing anybody and stuff like that, it can be quite lonely, although being in a new place is also interesting. The other thing I probably miss a lot is the food in Singapore. So it's not easy to find Singapore food over there, or even Asian food. So since I've been back, I've been visiting a lot of hawker centers and ordering local food.
So glad to see you in person again. You know, for the past 6 months, we have been seeing you through a screen. But glad to see that you're doing well and settled well in Turkey. Today's topic, we are going to talk about retirement and retirement strategies. You know, you have met with many clients. What are their main concerns when it comes to retirement?
I think for most people, when they're retiring, they're really trying to answer the question of whether or not they have enough to retire, right? A lot of the time, they're worried about having a reliable income stream in retirement. A lot of them, it is quite difficult to make the transition from being salaried, having some sort of active income, being able to earn some of that money that they spend, and then transitioning to sort of spending from the resources that they've already accumulated. So I would say that's probably what most of them are thinking about in various different ways, whether or not they have enough to support the lifestyle that they want.
Right. So at Providend, we have actually identified 5 key risks in retirement, namely longevity, inflation, healthcare, investing, and overspending. So could you briefly explain what these 5 key risks are?
Thanks, Isaac. So as you've mentioned, there are 5 key risks in retirement that we think about most often. The first is longevity. So as the name suggests, it's really about the risk of living too long. Because if you live too long, then you might outlive your resources. And then if you don't have any money in your older age, that will be troublesome. The second is inflation, which is really making sure that in your retirement, your assets, the income that you're able to generate keeps up with inflation, and so that you maintain your spending power and that over time your quality of life is not decreasing. The third would be healthcare, which nowadays is talked about a lot in Singapore, which is really the rising cost of healthcare, and also the fact that as you age, the chances that you will be struck with some sort of ailment will rise, and you need to be able to address some of these costs that are associated with those situations. The fourth is investing. Investing risk is really about the risk that is associated with having your assets put into the market. So the market fluctuates, and that can create some risk depending on when you need the money, etc. At the same time, there's also a key risk that people should be aware of in retirement. That's the sequence of returns risk, which also falls under investing risk. Essentially, depending on the order in which returns materialize each year, that can significantly affect whether or not you run out of money in retirement. And the last is overspending. It's really a spending risk. Overspending is more commonly talked about, which is if you spend more than you can actually afford and then you run out of money. But equally important at Providend, we think that underspending is also a risk. Because nowadays, people want to make sure that they are able to use their resources while they're alive, and that they don't leave too much behind and they can't bring it with them wherever they go after.
Right. So underspending would be for people who are they're like, maybe I shouldn't spend so much. What if I don't have enough? They don't really have that calculation or the parameters, when they are calculating what they can spend in their retirement. So is that what leads to underspending?
Yeah, I mean, I think it's a few things. Part of it could be cultural. So I think, especially in Asia, a lot of people have a very healthy habit of saving across their lives. They're very frugal. They may always save. So that's one thing. But the other thing is that it also becomes a habit after a while. So after you have always saved and, tried not to spend too much, it becomes very hard to sort of switch gears and say that you're going to spend from your resources, especially if you are already used to saving most of your life. And then the third reason would be, like you mentioned, if one were not to have any clarity on how much they can actually spend sustainably, then it becomes a lot more scary and you will tend to err on the safer side, right?
Yeah.
Spend less.
Yeah, right. So our focus today will be on investing risk. And of course, a very hot topic in recent times, inflation. So just now, you mentioned for investment risk, there is a sequence of return risk. So why is this risk not as pertinent for accumulators and people who are saving and investing towards retirement, but could be devastating for retirees?
Right. The reason that sequence of return risk is very pertinent for accumulators is really because, as the name accumulators suggests, people who are in that phase of life are still younger, they're still working, they are still accumulating assets. What that means is that they are adding towards their investment portfolio rather than drawing down from it. What that means is that if you look at the average return of the markets, maybe in the MSCI world over recent history has done about maybe 9% or so, then you know that if they hold for a significant period, they are going to get something close to that average return. However, if you are in your retirement, you're actually spending from your assets, then it means that you have to sell or draw down a small portion of that every year. And then the order of the returns matters rather than just the average return. So for example, if you have a very bad negative return in the starting years of your retirement, that will both impair the portfolio in terms of current value, but at the same time, it also causes you to sell while the market is down.
Right. So if let's say there's a bear market, for accumulators, they'll just like, what, my retirement is still 15, 20 years away. You just like, you can just wait it out. In fact, you can still top up because you're still earning an income. But for retiree, it's something that, when the market is down, you probably don't have an income anymore. So you're living off your investment. So you would have to sell at the low.
Yeah, you're right. So behaviorally, it is easier if you have an income because you know that you don't have to touch your investments. You can spend what you're earning. So behaviorally, it's easier. But also in terms of the practical application, if you are a retiree, you don't have an income anymore, then the only place that you can get your money is from your portfolio. So you're forced to actually sell when the market is down.
Right.
Yeah.
So the next one would be inflation. So prior to 2022, we have experienced a decade of inflation hovering between 0 to 2% per annum.
Yep.
I still remember when we use 3%, in our planning assumption for retirees, and a lot of people were saying like, is that a bit too high? But nowadays, we're hearing people say like, it's 3% too low. So with the sudden spike of inflation, they're about 10% for most developed countries. Is that something that should be a cause of concern for retirees today?
It is a cause of concern, and it's definitely something that will be on retirees' minds. I think as planners, we are also looking at it very carefully. We are also thinking about some of these situations, about how it should be handled. On the whole, though, we do know that historically there are periods where there are spikes in inflation, but they typically don't last extremely long. And if they do, then that's a different question altogether regarding whether or not we need to sort of consider changes to the plans that we've made with clients.
So far it's only been 2022. As of recording, inflation seems to be trending downwards. If let's say we are too reactionary, we start taking everything around and making different assumptions, it might not be the most, or rather might not be the wisest thing to do.
Yeah, that's true. And I mean, for retirement, most people who retire, maybe if they're 50 plus or if they're 60 and they still have another 30 years to go, that's quite a significant period. And we still expect that in the long run, inflation will trend towards the somewhere between 2 and 3% level. So that's the expectation has not changed, or at least this spike in inflation so far is not really a reason for us to conclude that it will be that way in the long term.
If let's say an individual wants to protect themselves from inflation, inflation risk.
Yeah.
So what kind of instruments or empirically sound instruments can they use to hedge against long-term inflation?
That's a good question. I think everybody is thinking about that, especially, or was thinking about that maybe over the past couple of years. There are a few different instruments out there that are pretty good at hedging against inflation. One of them, although not accessible from Singapore, would be inflation-linked bonds. Those are mainly accessible in the US, but they also have limits on how much you can actually get. Some other things that people like to think about are things like gold, things like some sort of commodities, etc. And then, of course, the last one, which I would definitely like to talk a little bit about, is equities. So I think a lot of the time people don't think of equities as an inflation hedge, but it's actually quite a good way to hedge against inflation.
Right. So what instrument do we use at Providend, to hedge against inflation in that case?
Mainly the equity allocation. So I think with some of the others, of course, inflation-linked bonds are directly tied to inflation. When there's no inflation, however, they do quite poorly. And then there are also limits on whether or not you can have access to them. Regarding gold, even though people seem to perceive that it's going to be a good hedge against inflation at all times, there are a lot of historical periods where inflation has been high, but gold has not hedged that well. So at Providend, we really use our equity allocation for clients to hedge against inflation, in the sense that typically in periods where inflation is high, stocks will also still do okay, particularly if you're invested in the right sort of portfolio. Right. So, I mean, if you're looking at the large companies, those established ones, or you are in a very diversified portfolio, then by and large, some of these companies, or the stronger ones, will be able to hand on some of these increase in costs to their consumers and increase and maintain or even increase their profits. Right. So then they will tend to do well even in these inflationary times.
Yeah, so like companies with strong pricing power, for example, if they say they raise their price, then they're not going to lose as many clients, as many customers.
Mm-hmm. Yeah. I mean, you can think about it in terms of the value that they create. So even though money may be getting devalued, the things that they produce, the services that they provide are still things that people will need to use. Whether or not people need to pay more for them, they will still use them. So things like food, things like essential services, and the economic value that these companies are producing will be worth more in those inflated dollars. So then they can maintain or grow their profits.
Right. Okay, so on to retirement spending strategies. Mm-hmm. So, in the world of finance, there's so many different strategies for retirement spending.
Yep.
So today we'll be touching on a few. The first one would be the very famous study called the Trinity study, or most people call it the 4% rule.
Yes.
Before 2022, the past decade was a long bull market, and it coincided with the rise of the FIRE movement. Or rather, the FIRE movement was around for quite a while, but the past decade really led to we have seen a huge increase in interest in this. So the FIRE movement is basically financial independence, retire early. The most popular strategy mentioned within this group is the 4% rule. Could you briefly explain what this Trinity study is and what the 4% rule is?
Sure, Isaac. So the Trinity studies is actually a series of studies done by 3 professors from Trinity University in San Antonio, Texas. Right. Their work is actually based on the idea of William Bengen, who people say was the first to sort of define the rule. What he was trying to really find out through his work was how much you can spend from a retirement portfolio without running out of money, and then how long you need to accumulate such money, and then how long will it last. So typically when people say the 4% rule, they're referring to the case where you have a portfolio of stocks and bonds, about 50-50 allocation. And then if you use an initial withdrawal of about 4% of that portfolio, and then you adjust that withdrawal by the inflation number as according to the CPI, the Consumer Price Index, then you can continue spending from that portfolio for about 25 years without running out of money.
Though you often use this as a rule of thumb, can you explain why, at Providend we don't implement this drawdown strategy for our clients?
It's a good rule of thumb. For one, the 4% rule is helpful in trying to gauge whether or not you have reached roughly the number that you need for financial independence.
Right. So if let's say, I need 40,000 a year.
Yeah.
Okay, you want 40,000 a year, you can just use like the 4% rule to say, okay, you need roughly about 1 million. Is that correct?
Yeah, exactly right. So you would either divide that 40K, that annual expenditure, that 40K by 4%, or in other words, you multiply it by 25 lah.
Yeah.
Yeah. Then you will get the rough amount that you need for financial independence for 25 years. Of course, we don't use that in particular for a number of reasons. One, you may have a different retirement time horizon, right? Not everybody is going to retire for 25 years. They could retire earlier for longer. Of course, there are studies that can also indicate the safe withdrawal rate, which is what the 4% rule is actually articulating for different periods. But of course, 4% only works, or at least has only shown to be effective for that 25-year period. And in that particular allocation of 50-50. So right. If you have anything else different, then
So especially with life expectancy, every year we can see in most developed countries is going up.
Yeah.
So I think the life expectancy when the study was conducted, when it was first conducted in 1998, was, let's say, maybe roughly like 5 years, less than what it is today. Could that be the reason why this study is there are a lot of works that came after this study, right?
Yes, yeah, definitely. Because this 4% rule only applies to a very specific case, then a lot of other work has come up to define the problem differently with different investment time horizons, different portfolio allocations, etc. But I think one thing to remember that is important for this particular strategy is that it requires a lot of discipline, and it requires the investor or the retiree to take a very mechanical approach. So they really have to follow the rules to the letter, right? They have to have the exact same allocation that is prescribed. So in this case, 50-50, they can only withdraw 4% initial, and then they have to adjust by inflation every single year. That means doing it regardless of whether the market is going up, whether the market is coming down. Sometimes if the market is coming down and your portfolio has shrunk, then it may not feel right to actually spend more than you were last year, for example. And so part of managing such a strategy is behavioral, and it's quite difficult to state the cost and do it exactly as prescribed.
Right. Okay, thanks, Bryan. So another popular strategy is dividend investing. So many people talk about living off dividends either through dividend stocks or REITs, so they'll say something like, I just need to buy like these few stocks that they're paying me a very consistent dividend.
Yes.
And then I'll just live off it, and, it's something that I can do forever. As long as that you're not drawing down on capital, you're just holding on to the REITs and you're just collecting the income. So, what's our take on this strategy?
It is definitely a valid strategy. I think many people have managed to do it successfully. But of course, on the flip side, there are many people who also have tried to employ it, but maybe don't get as good results.
Yeah.
I think there are a few challenges in using this strategy. One is that, in some ways, it is sort of concentrated. For example, if you had a portfolio of 20 stocks or 30 stocks, but a lot of them were in the banking sector, or a lot of them are in REITs, for example, which is where people go looking for dividends. Then that can present some sort of concentration in terms of
recently
sectors.
the banking sector and then REITs not doing too well.
Exactly right. So the banking sector, of course, was hit in the news recently. SVB, etc., Credit Suisse. But on the other hand, REITs also, in a rising rate environment, have been struggling with the rising costs of financing and stuff like that. So they have not done too well in maybe the past year or so. Although that's not to say that that will always be the case. I suppose one of the other things to think about is that for dividend strategy, that's tantamount to holding a 100% equity portfolio throughout your retirement, which behaviorally is quite difficult because there will be significant volatility associated with that portfolio. And that kind of 100% allocation to equity may not be right for everybody.
Usually when there is like market drawdowns or bear markets, we can see some companies actually starting to cut dividends, for example. So let's say you are in retirement and you have some fixed expense that you have to cater for. And, if there's, let's say, like one of your main holdings like have a dividend cut, so that would definitely affect your lifestyle basically in retirement.
That's one of the other challenges would be that I guess when you invest with dividends, there's some uncertainty to what the dividends will be. We can do due diligence and all that, but there always may be situations where a company declares a dividend that perhaps is smaller than what you expect. In that sense, you have less control over the actual income that you get. That's really determined by the market, the companies, and the decisions that they make. At the same time, selection is also something that's quite difficult. It's not easy to select stocks that will maintain their value over time, that will maintain their dividend or even grow their dividend over time. And on that point, the last bit just about the growing dividend, right? A lot of the time when we think about a portfolio, let's say we have $1 million in dividend stocks and maybe it's giving us a 4% dividend return. Then we spend 40K a year. That doesn't really account for inflation either. Right, in terms of your growing spending needs over time. So, selecting the right stocks is key and is usually not something that everybody has the time to really delve into very deeply.
Right. So what is Providend's approach then? Since the 4% rule, it has its flaws, and of course, dividend investing as well, as you just mentioned. Of course, the Providend approach would not be entirely flawless, but why do we choose to use our proprietary methodology, RetireWell, which is actually a cash flow management tool?
Yes.
It is quite similar to what some may call a bucketing strategy. But
it is a kind of bucketing strategy.
It's a kind of bucketing strategy. But could you briefly explain what RetireWell is?
As we just said, it's a kind of bucketing strategy based off of some of the bucketing strategies that have arose in the US. But really what we have done is brought it back to Singapore and then adapted it to our needs. It would include things like CPF. It would include some of the features of the local landscape. What it looks like for our clients generally is that we will split the assets that they have today across 6-7 different buckets. And each bucket will be invested in a different portfolio that will be used to support their retirement in a different way. So the first would be the income bucket, which is really where we place their income producing assets. So it could be rental income, it could be CPF Life, like I mentioned earlier, it could be dividend producing stocks or funds. And really what that is supposed to give them is a very good base for their retirement. So something that will give them a fixed amount of income to support their most essential expenses. And then from there, we need to make up the rest of their desired income from investments and make up for inflation adjustment as well. So depending on the time horizon of the different buckets, let's say bucket 1 will be mostly in cash. And that's really for their first 5 years of expenses. But once you go to bucket 2, to bucket 3, and further, you will have a little bit of a time horizon, which then you can use that to take some risk.
Why do we hold 5 years of expenses in bucket 1 in cash?
Yeah, so that's really in relation to the sequence of returns risk, which we talked about earlier, which is that if the market is not doing so well, we don't want our clients to be in the tough position of having to draw down from their investments to fund their life. So having that 5 years of cash really gives them the assurance that they don't need to touch their investments, and that from bucket 2 onwards, they have at least 5 years where those investments can be completely untouched.
Right. So if let's say a retiree started RetireWell at the start of 2022,
yes,
then obviously the market fell quite a lot last year. But knowing that your next 5 years of expenses are covered, really will give you sort of assurance, that you don't have to touch your investments and you don't have to sell it when it's low, and you have like a runway for markets to recover.
Yes, exactly right. So it gives you, it puts you in a position where you don't have to worry too much about selling out, especially in the short term. And then it also gives you a little bit of a runway to make the necessary adjustments before having to draw down from your investments in a bad sequence. So within those 5 years, you can still, review your expenses, see what you can adjust if necessary, to prepare for when you need the money from bucket 2, for example.
Okay, Bryan, bonus question. I'm going to ask you a question that I didn't really prepare you for. Drawing down versus perpetuity strategies. So which do you think makes most sense for retirees?
Okay. As a client advisor, this is a question which quite a few clients may ask along the way. Really because RetireWell, as we explained earlier, is sort of a spending plan and how you spend and deploy and use your assets in your retirement. A perpetuity, on the other hand, would be a strategy that assumes you should end up with the same amount or inflation adjusted the same amount that you started with. So essentially in a perpetuity, you would be generating some sort of income, but then not actually depleting your assets. I think ideally, everybody could have a perpetuity and then we just spend the income and then we still have this pot left over for those people that we love. But I think for most people, in a practical sense, it makes more sense to have a spending plan. If you do really have a desire to have a certain amount at the end of your retirement, we can also plan for that. But then what that really requires is then you have to start with a larger capital. It's not really just that you have the same capital, you deploy a different strategy and then you're able to generate the same amount of income without depleting your assets.
Right. Okay. Thank you so much, Bryan. Okay, that's all for today's episode. I hope you all enjoyed our discussion on retirement and retirement strategies.
Yes, thanks very much for inviting me, Isaac.
Yeah. So if you like this episode, please follow our podcast and follow us on social media for similar contents. As
like
always,
and share.
Yeah, as always, like and share. And thank you for listening, and I'll see you in the next episode. All analysis, views or opinions from interviews, recommendations and other information broadcasted, or published herein are provided for general information purposes only. Information expressed does not take into account any specific situation, particular needs or objectives and should not be construed as specific advice or a recommendation. Information has been obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed. Always consult with a qualified investment, legal or tax professional before taking any action. Providend Limited does not accept any liability for any loss whatsoever arising from any use of the information broadcasted or published herein. All contents and information contained herein may not be copied or reproduced in whole or in part by any means without prior written consent of Providend Limited.